What if 2026 isn't the year you make money, but the year you slowly lose it without even noticing? Right now, the market looks strong, but if you dig a little deeper, things start to feel very strange. Have you ever won something and still felt like something was off? Like the result was good, but your intuition was telling you, this won't last. 2025 didn't make much sense at all. Stocks were going up, AI was everywhere, and yet everyone kept talking about a recession. Unemployment stayed low, people kept spending money like credit cards were just a buy now, think later button, and the market, it kept climbing like nothing was happening. And that's exactly the problem. This isn't normal. Now it's 2026, and we're stepping into an even more unstable situation. Valuations are high, the market is being held up by just a few companies, and no one really knows what comes next. And here's the interesting part: the more news you read, the more confused you get. One expert says a crisis is inevitable, another says we're just getting started. The truth is, both of them could be wrong. A simple rule: when everyone is confident, that's when things break. But when everyone is afraid, the market often goes up. It's a paradox most people never get used to. Let's start with the obvious: AI. Many companies today are valued not for what they earn, but for what they might earn in the future. This is no longer traditional investing. It's like pre-ordering a product that doesn't even exist yet. You're paying today for a promise tomorrow. And here's the key point: when a few big companies rise, like Swire, they pull the entire market up with them. But when they fall they don't fall alone. And the problem is, drops usually happen faster than growth. It's like building a skyscraper on a single column. It looks impressive until it cracks. And once that crack appears, there's almost no time to react. Next, market concentration. You might think the S&P 500 means diversification. 500 companies, stability. In reality, not quite. A small group of giants drives most of the performance, which means your diversified portfolio actually depends on just a handful of stocks. If they go up, you're in profit. If they stall, the entire market starts to freeze. And this is where passive investing comes in. More money flows into index funds leads to more money goes into the biggest companies. They become even bigger. A feedback loop. It works perfectly until it doesn't. And the most dangerous part is that most people don't even realize what's inside their portfolio. They think they're investing in the market, but in reality, they're making a bet on a few names. The third thing people ignore during bull runs: cycles. Markets don't go up forever, corrections are normal. But here's the trap: even if you know a downturn is coming, you don't know when. And being early but right in the market often feels exactly the same as being wrong. Many people lose money not because they're wrong, but because they can't hold on long enough. The market doesn't care about your logic, and often not even about facts. So, what should you do in 2026? Instead of trying to predict one outcome, think in scenarios. Scenario number one: bearish. The AI hype fades, valuations drop, and the market corrects. Not because of panic, but because of a return to reality. Slowly but painfully. Scenario number two: bullish. Rates fall, money gets cheaper, liquidity increases, and the market keeps rising, even if the economy looks strange. And this can last longer than seems logical. Scenario number three: the most dangerous one. Almost no one talks about it. The market doesn't crash, but it doesn't grow either. It just moves sideways. A bit up, a bit down, no clear trend. And this is where most people lose money. Not because of a crash, but because of fatigue, emotions, and bad decisions. They start jumping between assets, chasing moves, trying to win it back, and slowly drain their portfolio. Boring markets are the most dangerous ones because they don't look like a threat. So here's the bottom line: Valuations are high. The market depends on a few companies. Corrections are normal. And most importantly, no one knows what happens next. And that's not bad news. That's reality. The same reality professional investors operate in. And if someone claims they know, they're either guessing or trying to sell you something. So instead of searching for the perfect prediction, it's better to learn how to think in scenarios and be prepared for different outcomes. If this video helped you understand the market better, subscribe and write in the comments, how do you see 2026? Growth, crash, or total chaos?